There's a stock that almost all analysts got wrong. If you had listened to these incompetent supposed experts on this topic, you would have lost 75% of your investment value between 2020 and 2023. While their bullish numbers might have given you a temporary dopamine hit, the serious depression that followed when you checked your account balance was inevitable. This stock is Alibaba, and today we're exposing 6 incompetent analysts from major firms who completely botched history with their incompetence. Investment is a highly emotional game. In fact, entire branches of economics and finance are dedicated to the behavioral aspects of markets. The best thing to do when investing is to leave your emotions at the door and proceed with sound logic, whether from a technical analysis standpoint, a fundamental analysis standpoint, or a hybrid of both. Benjamin Graham, the godfather of value investing, said in his book, The Intelligent Investor, that we all have an emotionally unstable friend called Mr. Market. Every day, Mr. Market will cheer you to buy or cheer you to sell. This Mr. Market is bipolar for sure. If you ever paid attention to his calls, you know why I'm saying that. If you actually listened to his calls, you likely dished out your savings to investments that lose you money, eventually winning you a seat in bankruptcy court. From Benjamin Graham's advice, it logically follows that you certainly don't want to ever engage in investor groupthink, thus adjusting your thinking to the masses and to that of your bipolar friend, Mr. Market. None of these analysts have paid attention to Uncle Graham's advice, and their numbers show it. We will coin and use the term analyst groupthink to describe this phenomena where analysts mimic each other's calls to avoid stepping outside the comfort zone, driven by fear of being wrong rather than making sound, independent judgments. This analyst groupthink leads to a herd mentality, resulting in inaccurate and often disastrous investment advice. For example, Eddie Leung of Bank of America Merrill Lynch consistently blew away the incompetence meter for this stock. In October of 2020, Eddie had a 320 price target on Alibaba when the stock was at its peak of 307 and a buy rating. He upped his target to 351 in February 2021 while the stock price plummeted to 227, a 25% drop. Instead of warning investors, he doubled down. It wasn't until August that he started to cave, still carrying a premium of over 30%, chasing down the stock without budging. While he had a little success when the stock was rising, his calls during the downturn were disastrous and cost many people their life savings. Absolutely egregious. Our next culprit for the day, Alicia Yep of Citigroup, was just as incompetent as her friend Eddie. As you can see on the chart, they both put in some hard work early when the stock was rising. Unfortunately, they both got a little too comfortable and overconfident as the stock peaked and then began to crash. They consistently overbid, adding bogus high numbers that were reactive to the stock as it was tanking. It seems after the peak in late October 2020, they threw a success party to celebrate their small wins. And as you can see from the chart, they unfortunately drank so much that they forgot to end the party and clock back into work. Alicia's approach was very similar to Eddie's, consistent double downs that backfired. She didn't change her stance either, mirroring the same emotional instability seen in Mr. Market, also displaying the analyst groupthink that we're focusing on in this video. Our next defendant in the incompetence court is Alex Yao of JP Morgan. Alex broke ranks in early 2022, going short just as the stock began to rebound. On March 14th, 2022, he shifted his target from 180 to 65 in a single day, only to backtrack to a 130 target, leading to another crash from 120 to 70. Alex, you finally started to see the light, and you were actually right on 3 of your calls. Why the hell did you change course? When looking at this, you almost feel bad for the guy. Yusuf Squali of Truist was attempting to break from the groupthink on Wall Street. For that, we applaud him. But unfortunately, he did so with gross incompetence and was later sucked back into the mass analyst incompetence craze. In November 2020, when the stock peaked at 308, Squali saw zero potential upside. In that, he called the peak spot on, being cautious as it rose and peaked. Yusuf eventually began to bid the stock up. Unfortunately for him though, this happened after the stock began to tank. And as you can see, the analyst groupthink is screaming on the chart, as all the mentioned analysts behave more or less the same in this period. By January 22nd, 2021, with the stock at 260, Yusuf upped his target to 326. By March 18th, 2021, 6 months after the peak, the stock was at 212. Not only did he fail to see the drop, but he doubled down and upped his price target to 330. He kept adjusting down while maintaining a buy rating. This erratic behavior, where he couldn't seem to commit to his evaluations, leaves us questioning whether he's a gambling junkie. I think he dropped into Eddie and Alicia's celebratory party. Those things that Wall Street guys do when they are partying have a nasty after effect on your brain. Calm down with that stuff, guys. You're going to hurt yourself. You already are hurting yourselves. Your numbers show it. Our final culprit for the day is Thomas Chong of Jefferies. No, he isn't related to Cheech and Chong from Up in Smoke, but when glancing his numbers, you might wonder if he's been indulging himself, given how out of touch his projections are. Thomas upped his price target to 372 on October 12, 2020. He then had a 285 price target when the stock was at 106. There was no change, no admission of fault, just a ludicrous potential upside of over 100% luring in gullible investors. His calls are not just reckless, but indicative of a complete disconnect from reality. From these analysts' behaviors, you can see recommendation after recommendation following the same irrespective pattern of promising profitable upside potential while ignoring the fundamentals that were warning of the downside. To add insult to injury, these analysts are just the tip of the iceberg. Analysts are required to report quarterly, and this happened for years. Absolutely egregious. The signs of Alibaba's crash were imminent. It is sickening how these analysts ignored the writing on the wall. Since 2020, Alibaba Group had encountered formidable challenges that profoundly affected its market position and stock price. One of the most significant blows came from a regulatory crackdown by the Chinese government, which intensified its scrutiny of major tech firms. In late 2020, authorities launched an antitrust investigation into Alibaba, culminating into a record $2.8 billion fine in April 2021 for monopolistic practices. This unprecedented penalty not only dented Alibaba's financial standing, but also eroded investor confidence, contributing to a substantial decline in its stock value. Compounding these issues was the dramatic halt of Ant Group's initial public offering. Ant Group, an affiliate of Alibaba, was poised to achieve the largest IPO in history in November 2020. However, just days before the planned debut, Chinese regulators suspended the IPO, citing regulatory concerns over financial risk management and corporate governance. This unexpected intervention was a stark reminder of the unpredictable regulatory environment in China, further shaking investor sentiment and casting a shadow over Alibaba's future prospects. Internal management challenges also played a role in Alibaba's troubles. The company's founder, Jack Ma, faced a significant backlash from the Chinese authorities following his public criticism of China's regulatory system in October 2020. His disappearance from the public eye for several months only fueled speculation and uncertainty. Additionally, the overall leadership transition within Alibaba has been under intense scrutiny, raising questions about the company's strategic direction and stability. The broader macroeconomic conditions have also been less than favorable. China's economic growth has been slowing, and the impacts of the COVID-19 pandemic have created a turbulent business environment. The global supply chain disruptions, rising inflation, and geopolitical tensions, particularly between China and the United States, have exacerbated the challenges for Alibaba. These factors collectively have led to a cautious outlook among investors who are wary of the heightened risks associated with investing in Chinese tech companies. Moreover, Alibaba faces fierce competition within the e-commerce and cloud computing sectors. Rivals such as JD.com and Tencent have aggressively expanded their market shares, intensifying the competitive landscape. This heightened competition has pressured Alibaba to increase its investments in technology and innovation, impacting its profit margins and overall financial performance. The convergence of regulatory pressures, internal management issues, unfavorable macroeconomic conditions, and fierce competition has significantly undermined Alibaba's market position since 2020. These multifaceted challenges have collectively contributed to a steep decline in its stock price, reflecting the complex and volatile environment in which the company operates. Meanwhile, these analysts ignored these key fundamentals, all the while touting that this stock was worth way more than its valuation. Aside from analyst groupthink and the actual copying of each other's calls mentioned earlier, there is a more sinister situation of copying across the board on Wall Street. These analysts all act in accordance, afraid to make calls that fall outside the unspoken quote-unquote acceptable range because they fear being wrong and facing scrutiny for taking actions outside the norm. J. Krishnamurti, a renowned philosopher and spiritual teacher, said that it is no measure of one's health to be well adjusted to a profoundly sick society. This statement fits perfectly in this context. Why are these incompetent fools attempting to mimic a broken norm? If we dig deeper, we can find a more sinister reason for this. It touches on something we hinted at in our last video on Disney, and no, we aren't talking about the whiskey party we mentioned in that video. Our reports do indicate that these 5 analysts were regularly seen at the whiskey party, but after the whiskey party, they all returned to their well-known comfort zone. You see, it is a well-known fact that the comfort zone is your enemy. The incompetent analysts who covered Alibaba stock are clear evidence of this. These analysts are just too comfortable. They don't take risks. They likely attended prestigious universities and received mahogany-encased diplomas credited to them for passing tests that were administered by people who never worked a day in investment. Then, they likely went to work in environments filled with people from the same background. All of them clinging to safety and afraid to make gutsy value judgments based on their analysis, simply motivated to stay within the norm and collect their undeserved, oversized paychecks, thereby perpetuating the status quo. The why of all this is beyond the scope of this video, but we can say that it is partly due to societal privilege. Fortunately, this is all changing thanks to YouTube and the honesty provided by the internet. And the chickens are coming home to roost on these incompetent analysts and the system of privilege that once awarded their incompetence. And the incompetence on Alibaba stock is due in large part to mass analyst groupthink that these analysts engage in. None of them have the guts to make the right calls, even if they know the mass of analysts are wrong, because the safety of the paycheck is guaranteed if they stick to the norm of this deplorable behavior rather than make sound calls based on actual analysis. Wall Street's system of stock analysis is certainly broken, and we will continue to expose the incompetence on this channel. Now, how can we use this information to better ourselves as investors? We will return to Uncle Graham's advice. The best thing to do is to understand that Mr. Market and his incompetent analysts are emotionally unstable, and their decision-making is not coming from logic, but from emotions that are maladjusted. Now, we understand that having professional advisors may be a necessary evil for some of you because you may not have full time to devote to portfolio management. We get it. But even for you, understanding the incompetence and being a proactive client will help you versus someone who is an incompetent client and allows these parasites to churn their accounts. So knowing the incompetence of the professionals will help you to make sound judgments off of the numbers they dig up after running your own sound analysis. There is no shortcut to that last part. You have to do that work. Warren Buffett is worth around $100 billion, and even he still does that work. And so should you. Sorry, we're not snake oil salesmen here. We have to be honest about that. Now, advisors can streamline the front end of the work and dig and give you some options that will save you some time, but you are ultimately responsible for your financial destiny. And you have to own that and make the ultimate decision, and never give advisors power of attorney. If you're going to trust them with your financial future, then we have a bridge to sell you for $5 less than they are charging you. Our bridge will earn you 100% compounded continuously. Terms in our 200-page document crafted by our blood-sucking lawyers will apply. So heed this warning and do not ever listen to Mr. Market. Definitely remove your emotions from your investment decisions that are to be made based off of sound analysis from either or both of the above-mentioned schools of thought, fundamental analysis or technical analysis. And do behave competently. whether as a client or as a direct investor. If you liked our content, be sure to like, subscribe, and hit the notifications icon so you are notified accordingly. Thanks for watching, and continue to tune in to Incompetent Capital, where accountability for competence on Wall Street is our top priority.